Top of the morning to you, and welcome to our newest episode of Capital Markets Quickie from MVP Mind Value Partners. After 3 consecutive weeks of positive performance, the U.S. stock market declined modestly last week. The S&P 500 finished the week with minus 0.53%. The Nasdaq with minus 1.35%. Out here in Europe, the Euro Stoxx 50 ended the week with minus 1.44%, and the German stock index DAX with minus 2.04%. All in all, red numbers across the board, except for silver, which gained more than 7% on the week. My name is Endrit Cela, coming at you from Frankfurt, Germany, Europe's financial hub and home to the ECB. Let's take a closer look at what moved the markets this week. Yes, the US stock market did finish the week off in the negative after 3 consecutive weeks of slightly positive performance. Well, I am not surprised one bit. After all, the news flow all over America was dominated by headlines around the negotiations for another round of fiscal relief from Washington before the elections, which is just around the corner. However, it's not all bad news. The bond market seems to be pricing in a Joe Biden win. As a result, the 10-year rates for U.S. Treasuries rose to the highest level in 4 months. That is a signal that the market has a more positive outlook towards economic growth next year. So it appears the market is reflecting a view that a Biden win, while likely to bring higher tax rates for businesses and high income earners, could also come with a larger fiscal aid package and/or infrastructure bill, which would offer a boost to near-term GDP. But as I'm sure you noticed, the title of my podcast today is telling you to brace yourself for the bumpy ride. Experts are anticipating the markets to swing widely around the election, particularly if November 3rd produces a contested or inconclusive result. But we should also reflect on past elections, and we'll see that election-driven volatility was not a good indicator to abandon your long-term investment strategy. For example, markets swung widely in the week leading up to the election of 2016, as I'm sure you remember. They became even more volatile in the overnight markets as the election results came in and eventually found a boost the day following the election, rising more than 1% on November 9th of 2016. So that's why I want to take a closer look with you at how the US stock market has performed throughout presidential terms. For example, the S&P 500 saw a healthy rally following the election of 2016, rising more than 20% in 2017 with historically low volatility. And overall, throughout the last years of Donald Trump's term in office, the stock market has risen 62%, which included the pandemic bear market, of course. Well, the S&P 500 rose 58% from 2009 through 2012. These were the first 4 years of the Obama administration, which also included a portion of the global financial crisis and Great Recession. Let's not forget that. And since World War II, the average stock market return in the 4 years between presidential elections is 37%. There were only 3 4-year terms in which the market was negative for that period. We should, however, keep in mind, March 23rd of this year was the pandemic bear market low, with the fastest drop in history from record highs to finding a bottom. And the S&P 500 fell by over 35% in just over a month, and that produced the first bear market in more than a decade. Since March 23rd, equities have returned to new highs, including a 60% rally from late March to early September, which is one of the most vigorous starts to a market recovery in history. Before we end today's episode, we have an anniversary to celebrate. Last week brought the 33rd anniversary of what is known as Black Monday. On October 19th, 1987, the Dow Jones fell 23% in just one day. That was the largest single-day decline for the stock market in history, ever. Just to put things into perspective, the second largest decline on record happened earlier this year when the Dow Jones fell 13% on March 16th of 2020. Black Monday serves as a good reminder of why it's important not to panic or abandon your strategy when daily declines reach extremes. The Dow Jones had its 8th best day on record 2 days after Black Monday, rising by over 10% on October 21st, 1987. And the Dow Jones had its fourth best day in history earlier this year, rising more than 11% on March 24th of 2020. Volatility is as normal as the waves in the ocean. If the captain knows where he's going and has a clear strategy on how to get there, it's not very smart to abandon ship and swim in the big ocean all by yourself. And that, ladies and gentlemen, concludes today's Capital Markets Quickie. To all of you listening from every corner of the globe, I wish you all the best and stay tuned for our next episode on Sunday, November the 1st.